There are only three ways a smart person can go broke, and they all start with the letter L: liquor, ladies, and leverage. The first two were added for the alliteration, because the real killer has always been borrowed money. This is not a speech about alcoholism or divorce, though both can certainly destroy wealth. What I want to talk about is leverage, which remains the single most reliable method for intelligent people to convert fortunes into rubble. And I'll explain why using simple arithmetic, a few historical examples, and some uncomfortable truths about human psychology. The mathematics here are elementary. A string of wonderful numbers multiplied by zero always equals zero, and it doesn't matter if you've compounded at 20% annually for 30 years. Your IQ is irrelevant. Your track record means nothing. One zero in the sequence eliminates everything that came before it. Leverage creates zeros. Let me start with the basic math, because this is where most people's thinking goes wrong. Without borrowed money, the worst outcome is losing what you put in. $100,000 invested in a stock that goes to zero means you've lost $100,000, which is bad but survivable. Your house remains, your savings account still exists, and your future earnings haven't vanished. Recovery is possible. Borrowed money changes the math completely. A decline of any size can wipe you out entirely when you've used margin to invest, not just the investment itself, but everything. Your broker calls in the margin, forces you to sell at the worst possible moment, and if the decline is severe enough, you end up owing more than you started with. Here's the insight that matters. Markets routinely experience declines of 30, 40, 50% or more. Berkshire Hathaway stock, one of the greatest investments of the past 60 years, has declined by more than 50% on 4 separate occasions. 2-to-1 margin on that stock would have wiped you out, and not just once, but 4 times over. Every single time, the stock recovered and went on to new highs. None of that helps you if forced selling at the bottom liquidated your position because your broker demanded more collateral than you had available. This is the fundamental asymmetry at work. Gains are limited by what you can realistically expect from markets, but losses can exceed everything you own. Let me tell you about 16 of the most intelligent people ever assembled in one business. John Meriwether, a legendary bond trader, founded a hedge fund called Long-Term Capital Management in 1994. The team he assembled included 2 Nobel Prize winners in economics, Myron Scholes and Robert Merton, along with some of the most sophisticated quantitative minds on Wall Street, names like Eric Rosenfeld, Larry Hillebrand, Greg Hawkins, and Victor Haghani. These 16 people probably had as high an average IQ as any group working together in one business in the entire country. Collectively, they brought somewhere around 350 to 400 years of experience doing exactly what they were doing. And most of them had put virtually all of their very substantial net worths into the fund. Hundreds of millions of dollars of their own money. 4 years later, in 1998, Long-Term Capital Management collapsed. $4.6 billion vanished in less than 4 months, and the Federal Reserve had to coordinate a $3.6 billion bailout to prevent the collapse from spreading through the financial system. How did the smartest people in the room go broke? They operated at 25-to-1 leverage, sometimes higher, holding approximately $125 billion in assets on roughly $5 billion in equity. When Russia defaulted on its debt and markets moved against them, their positions collapsed faster than they could exit. What fascinates me about this story is that these were not fools. They were not greedy con men running a scam. They were legitimate geniuses who understood risk management at a theoretical level that few people ever achieve, and they still blew up. Leverage doesn't care about your IQ, your track record, or your credentials. The only thing that matters is whether you can meet your margin calls when markets move against you. And markets will move against you at the worst possible time in ways you didn't anticipate for longer than you can remain solvent. The lesson is simple. To make money they didn't have and didn't need, they risked what they did have and did need. That is foolish, and your IQ doesn't change that equation. You might think the long-term capital management disaster taught Wall Street a lesson, and you would be wrong about that. March of 2021 brought another spectacular collapse when a hedge fund manager named Bill Hwang lost approximately $20 billion in 2 days. His fund, Archegos Capital Management, had been using 5-to-1 leverage through a financial instrument called total return swaps $20 billion, gone, 48 hours. The banks that enabled this leverage fared badly as well. Credit Suisse lost $5.5 billion from its exposure to Archegos, and the entire episode was massively stupid, which are the exact words that describe it. Credit Suisse managed to be the biggest fool of all. Here's what makes this interesting. The prime brokers knew they were dealing with a reckless client, and they were getting paid handsomely for the privilege. The lure of easy money, the fees from facilitating enormous leverage trades, overwhelmed whatever risk management processes they had in place. This is a recurring pattern. The people enabling leverage often understand the risks better than the people using it, but they do it anyway because the short-term profits are irresistible. The fees get collected today, and the catastrophe happens later to someone else on someone else's watch. Total return swaps with murky accounting and no position limits, which meant the leverage could grow without regulatory oversight. Unlimited leverage, kept off the books, subject to creative accounting. A wise regulator stops this stuff before it starts, but wise regulation is rare. Understanding why leverage regulation exists at all requires going back further in history. Before the crash of 1929, investors could buy stocks on 10% margin, meaning $100 purchased $1,000 worth of stock. The mathematics of this arrangement are worth pausing on because they explain everything that followed. If you put down $10 and borrowed $90 to buy a $100 stock, a 10% decline wiped out your entire investment. A 20% decline meant you owed money you didn't have. When prices started falling, margin calls cascaded into forced selling, which caused further price drops, which triggered more margin calls, and the spiral fed on itself until the market collapsed entirely. This wasn't panic in the emotional sense. This was arithmetic playing out exactly as the numbers demanded. Brokers had no choice but to sell their clients' positions to recover their loans, and those forced sales pushed prices lower, which triggered more margin calls at other brokerages, which forced more selling. The crash didn't happen because people were irrational. It happened because the system was designed in a way that guaranteed catastrophe once prices started moving in the wrong direction. During hearings in 1932 and 1933, lawmakers recognized that unusual amounts of leverage were one cause of the catastrophe, and they decided it could pose dangers to the entire economy. This was a good idea, a totally sound idea, one of the wise responses to emerge from that period. The Federal Reserve received authority to set margin requirements, and they used that authority 23 or 24 times between 1934 and 1970 to prevent excessive leverage from building up in the system. When speculation heated up, they raised requirements. When things cooled down, they lowered them. The system worked because someone was paying attention and had the power to act. Memories fade. Regulations get weakened. New financial instruments get invented that circumvent the old rules. And every generation seems determined to relearn the same lesson the hard way. The specific mechanism changes. Margin accounts give way to total return swaps, but the underlying dynamic remains identical. Borrowed money amplifies gains on the way up and destroys everything on the way down. The problem with learning from history is that people convince themselves their situation is different. The models are better now. The risk management is more sophisticated. The financial instruments have distributed the risk more broadly. Every generation believes it has finally solved the problem that destroyed the previous generation, and every generation turns out to be wrong. And then something happens that the models didn't predict, the risk management couldn't handle, and the broadly distributed risk turns out to be concentrated exactly where it can do the most damage. The faces change. The dollar amounts get larger. The fundamental story remains exactly the same because the arithmetic of leverage hasn't changed since 1929 and never will. Hedge funds and Wall Street make for dramatic stories, but leverage destroys ordinary people just as effectively. Consider the typical household. Spend a little bit less than you earn, and you'll gradually accumulate wealth. Spend a little bit more than you earn, and you've got debt, which means chances are you'll never get out. The difference between these two paths is remarkably small in percentage terms, but enormous in outcomes. Someone earning $50,000 who spends $48,000 builds wealth slowly but surely. Someone earning 50,000 who spends 52,000 digs a hole that gets deeper every year. Once you get into debt, it's hell to get out, and this is basic arithmetic that anyone can verify. 18% interest on credit card debt makes getting ahead impossible because you are compounding in the wrong direction. The same mathematical force that builds fortunes over decades is now working against you around the clock, and it never sleeps, never takes a day off, never forgets to charge you interest. Simple math illustrates this clearly. $10,000 at 18% interest with minimum payments means you will pay approximately $30,000 over 25 years to eliminate that debt, 3 times what you borrowed. Think about what that means in practical terms. You bought something for $10,000, perhaps furniture or a vacation or clothes you didn't need, and you ended up paying $30,000 for it. All that time, the money flowing to interest payments could have been compounding in your favor instead of against you. Run the numbers in the other direction and the contrast becomes painful. That same $10,000 invested at 8% for 25 years grows to nearly $70,000. The difference between carrying credit card debt and investing the money instead isn't $20,000. It's closer to $100,000 over a working lifetime, and that's just from one $10,000 decision. The first rule of compounding is never interrupted unnecessarily, and debt interrupts compounding. It takes the most powerful force in wealth building, time and compound interest, and turns it into a weapon pointed at your own head. Every dollar you pay in interest is a dollar that can't compound in your favor, and the lost compounding is the real cost, not just the interest payment itself. A mortgage on your house is an exception, and even then only a sensible mortgage you can comfortably afford. You need somewhere to live. Real estate generally appreciates over long periods, and mortgage interest rates are far lower than credit card rates. Credit card debt carried month to month is something different entirely. Consumer loans for things you don't need are not leverage in any meaningful sense. That's slow-motion financial suicide dressed up as convenience. Here's an observation that troubles me. Significant fractions of the population behave like alcoholics with credit cards, right up to their limit every month. They cannot walk past a store without buying something. They cannot see a zero balance without feeling compelled to spend it. The credit card company raises their limit, and they immediately spend up to the new ceiling. That does not strike me as a wonderful way to have a civilization function, and it certainly doesn't represent a path to personal financial security. The math guarantees these people will work their entire lives and end up with nothing, not because they didn't earn enough, but because they let compound interest work against them instead of for them. If leverage is so obviously dangerous, why do intelligent people keep using it? Human psychology provides the answer. We are wired to overweight potential gains and underweight potential losses. We believe we can time our exit before disaster strikes. We see others using leverage successfully and assume we can do the same. Most importantly, we confuse recent experience with permanent truth. Markets going up for 10 years leads us to assume they will continue going up, so we take on leverage because the trend seems safe, and then the trend changes. Envy creates problems as well. Your neighbor appears to be getting rich faster than you because he's using leverage, and hedge fund managers are earning billions with borrowed money. The thought creeps in, why am I being so conservative when I'm leaving money on the table? This is exactly backward thinking. The relevant question is not how much more you could make with leverage. The relevant question is what happens to you if you're wrong. If you're already comfortable and secure, using leverage is really crazy. The incremental value of getting a little extra return is not that great when you already have enough, but the incremental cost of a catastrophic loss is enormous. This is asymmetric risk in its purest form. You're risking everything to gain a little more, which means the upside is limited while the downside is unlimited. Only a profound misunderstanding of probability or an overwhelming case of overconfidence makes this seem like a good bet. Honesty about exceptions matters because absolutism on any subject is usually wrong. Certain forms of leverage don't carry the same risks as margin debt. Insurance float provides a good example. When an insurance company collects premiums today and pays claims later, that money can be invested in the meantime, functioning like leverage because you're investing money that doesn't belong to you. The difference is that it cannot be called during a market downturn. and nobody can demand you pay it back tomorrow because the stock market fell. This is the key distinction: callable versus non-callable leverage. Margin debt can be called at the worst possible time. Insurance float cannot. A fixed-rate mortgage on your home works similarly. That is leverage, but leverage on favorable terms, because the bank cannot demand immediate repayment when house prices drop. You have decades to pay it off, and as long as you can make the monthly payment, you control the timing. The danger lives in leverage, where someone else controls when you have to pay. That's when smart people go broke. That's when forced selling at the bottom wipes out years of gains. Very favorable opportunities might justify modest leverage for experienced investors who truly understand what they're doing and can withstand the potential losses. But most people should avoid it entirely. The young man knows the rules and the old man knows the exceptions. If you're not certain you know the exceptions, you should follow the rules. Let me share something about why warnings against financial destruction carry weight when they come from people who've experienced it personally. Imagine being 29 years old, divorced, having lost everything in the divorce, moving from a comfortable home to dreadful bachelor quarters, driving a terrible car with a bad paint job specifically to discourage gold diggers because you have nothing left to attract someone looking for money anyway. The following year brings news that your 8-year-old son has leukemia, incurable at the time. No health insurance exists to help, so you're paying everything out of pocket. You visit your child in the hospital daily, then walk the streets crying, and you watch him die at age 9. At 31 years old, divorced, broke, and burying your child. This is not a hypothetical scenario. This is the actual experience of someone who later became one of the most successful investors in history. And when someone who has been to the absolute bottom warns you about the ways smart people destroy themselves financially, that warning carries a different weight than abstract theorizing. The person who rebuilds from nothing without relying on leverage to accelerate the process understands something important. The goal is not to get rich quickly. The goal is to get rich permanently and avoid the catastrophes that send you back to the starting line. Approaching this from the other direction often provides the clearest way to think about complex problems, and inversion is one of the most powerful mental tools available. Instead of asking how to get rich, ask how to go broke, and then avoid doing those things. Make a list of every behavior that has reliably destroyed wealth throughout history, and simply don't do any of them. This sounds almost too simple to be useful, but it works precisely because most people ignore it. They spend all their energy searching for the clever path to riches, while walking directly into obvious traps that have been destroying fortunes for centuries. Smart people go broke by using leverage. They don't need to chase returns. They don't require to fund a lifestyle they can't sustain. They go broke by confusing a bull market with personal genius, mistaking luck for skill, and doubling down at exactly the wrong moment. They go broke by assuming the future will look like the recent past, extrapolating the last 10 years forward, as if markets move in straight lines. They go broke by taking risks appropriate for someone with no dependents and applying them to a life full of responsibilities, betting the college fund on margin because it worked for some guy on the internet. Smart people go broke by believing they can time their exit, always certain they'll sell before the crash comes, never accounting for the fact that crashes happen faster than humans can react. They go broke by thinking they're smarter than the market, convinced their analysis has uncovered something millions of other investors have missed. They go broke by assuming disasters happen to other people, as if financial catastrophe checks your credentials before arriving. They go broke by failing to imagine what happens if they're wrong, running the numbers only on the upside scenario, while ignoring the scenario where everything falls apart. Write down that list, tape it to your wall. Read it every time you're tempted to do something clever with borrowed money. The path to wealth is not hidden. The obstacles to wealth are clearly marked, and people walk into them anyway. If you want to get rich, the simplest approach is to avoid going broke, which sounds obvious, but almost no one follows it consistently. They get bored with steady returns. They get envious of faster gains. They get overconfident after a few good years. They convince themselves that the rules apply to everyone except them. And then they blow up, just like everyone before them who thought the same thing. Don't interrupt compounding. Don't take catastrophic risks. Don't borrow money to buy things that can decline in value. Don't assume you're the exception to rules that have destroyed people smarter than you. These are not complicated instructions. A child could understand them. Following them requires only the discipline to resist temptation and the humility to accept that you are not special. The goal is not to be brilliant. The goal is to avoid being stupid. And avoiding stupidity consistently over time is a more reliable path to wealth than chasing brilliant opportunities with borrowed money. Brilliance is rare and unreliable. Stupidity is common and predictable. Eliminating predictable stupidity from your financial life is worth more than any amount of brilliance, because the stupid mistakes are the ones that send you back to zero. Let me close with some arithmetic that illustrates why patience beats leverage every time. 8% annually with uninterrupted compounding transforms $100,000 into $215,000 in 10 years. 20 years brings $460,000. 30 years produces over $1 million. You didn't do anything clever. You didn't take any extra risk. You just sat on your assets and let time do the work. The alternative looks different. Leverage chases 15% returns instead of 8%, and your $100,000 grows faster initially. At some point over a 30-year period, and this is inevitable, you experience a drawdown that triggers a margin call. Forced selling at the bottom follows, and you lose everything, or close to it. The patient investor who earned 8% for 30 years has over $1 million. The leveraged investor who earned 15% for 15 years and then blew up has nothing. 0 times any number is 0. This is why the advice to sit on your assets and do nothing is actually sophisticated financial strategy. You're paying less to brokers. You're listening to less nonsense. You're not getting whipsawed by volatility. And if it works, the tax system gives you an extra 1, 2, or 3 percentage points per annum by deferring capital gains. The first rule of compounding is never interrupted unnecessarily. Leverage interrupts compounding. Leverage is incompatible with the most reliable path to wealth creation. This brings us back to where we started. There are only 3 ways a smart person can go broke: liquor, ladies, and leverage. The first 2 are there for alliteration. The third is the one that actually matters. Leverage is dangerous because it transforms temporary setbacks into permanent catastrophes. Markets decline, and that's what they do. A 30% drop is not a crisis. A 50% drop is not the end of the world. These things happen regularly throughout history, and they will continue to happen for as long as markets exist. The question is whether you're positioned to survive the decline and benefit from the eventual recovery, or whether the decline wipes you out entirely. The unleveraged investor experiences a drawdown. The leveraged investor experiences extinction. The goal of investing is not to maximize returns in any single year. The goal is to be around for the long term, to let compounding work in your favor, to avoid the zeros that eliminate everything you've built. A 20% return means nothing if it's followed by a 100% loss. The investor who earns 8% annually for 40 years ends up far wealthier than the investor who earns 20% for 10 years and then blows up. Survival is the only strategy that matters, because you cannot compound from zero. This requires patience. It requires the ability to watch others appear to get rich faster than you without abandoning your strategy. Your neighbor buys a bigger house with borrowed money. Your coworker brags about his leveraged returns. Social media fills up with people showing off gains that seem impossibly large. It requires understanding that the person who gets rich slowly and keeps their money is better off than the person who gets rich quickly and loses it. The tortoise really does beat the hare, not because the tortoise is faster, but because the hare eventually runs off a cliff. If you're comfortable and secure, the incremental value of getting a little extra return is not worth the risk of losing what you have. You don't need more. You need to keep what you've got. This is not a failure of ambition. This is wisdom. The person with $10 million who tries to leverage their way to $20 million and ends up with nothing has made the worst trade in history. They traded security and peace of mind for a slightly larger number that they didn't need and will never get to enjoy. Don't count on getting rich twice. The first time is hard enough. Building wealth takes decades of discipline, patience, and compound interest working in your favor. Rebuilding wealth after a catastrophic loss means starting over at an older age with less time for compounding to work. The math becomes nearly impossible. A 50-year-old who loses everything cannot simply repeat what they did in their 20s and 30s. The years are gone. The mathematics are simple. The psychology is hard. If you can master the psychology, if you can resist the temptation to use leverage, to chase returns, to believe you're smarter than everyone who came before, you have an enormous advantage over most investors. You don't need to find the next great stock. You don't need to time the market perfectly. You don't need any special insight or information. You just need to avoid blowing yourself up while everyone around you is doing exactly that. The advantage is not brilliance. The advantage is avoiding stupidity. And in the end, avoiding stupidity consistently and over decades is more than enough to build wealth that lasts.